in a futures market, you will have many different prices. Like, let's take, for example, I have a gold market. Now, there is a gold spot market. If I go to the secondary market and I try to buy gold, there is a price of gold on the spot market. That is something which we call the gold spot price. Now, at the same time, I can go to the futures market and I can buy gold for delivery on different dates. So if I buy gold for delivery on the 30th of June, we call that the 30th June gold price. Now, the 30th June gold price is different from the gold price for now. Okay, that's a very clear thing. Similarly, there could be a 31st July gold price, which is different from a gold price for now. So, whenever you have a futures market, attached to the goods is also a date. You don't just say gold. You say gold on 30th June, or you say gold on 31st July, and so on. We could discuss a market where we are trading gold for delivery on 31st of December 2002. That's fine, we can do that. But then that would be a different price from the price of gold today. Okay, so whenever we are talking about futures prices, attached to the goods there is always a date. You cannot talk about just a futures price. You always have to specify the date. And the futures prices which pertain to future delivery will always differ from the spot price which pertains to today delivery. Okay? Now, all of us keep hearing about arbitrage many times. Some people think that arbitrage is about buying at NSE and selling in Delhi Stock Exchange. Okay? From an economic perspective, arbitrage is about making money for free. Whenever you have a trading strategy which earns a profit without taking any risk whatsoever, that trading strategy is called arbitrage. Okay? So, arbitrage is not necessarily about any one particular kind of arbitrage. For example, in India, you might see people doing trading between NSE and Delhi Stock Exchange. That is an example of arbitrage, but there is much more to arbitrage. Whenever you have a trading strategy which makes what I call an undue profit without taking any risk, we call that an arbitrage strategy. Okay. Now, some people at the other extreme have this notion that when you are doing arbitrage, you will essentially make infinite amount of money within 0 time. That is also not true, because arbitrage does require capital and you don't have infinite capital, and arbitrage takes time to make money. Let me give you an example. Suppose I give you an opportunity where you take no risk whatsoever and you make 2% in a month. So you'd be very happy if on a 1 month horizon you get a 2% return, because normal interest rates in India on a 1 month horizon are clearly much below 2%. So arbitrage is about getting exceptionally high returns within a given time frame without taking any risk. So normally you ought to earn some 12% per year or 13% per year if you are not willing to take any risk. In an arbitrage strategy, you would earn more than 12% or 13% annualized. But that doesn't mean you make infinite returns. It doesn't mean you get rich quick. It doesn't mean you become a millionaire overnight. It does mean you make more money without taking any risk. Okay? So that's what arbitrage is all about. Now, in the area of derivatives, the most fundamental and the most interesting question is, how do we price the derivatives? So, you might place a futures, you might place an option. How do you price it? Okay? What is the meaning of saying that a futures is truly worth something? You know, you and I could have disagreements. I might say this futures is worth 5,000 rupees. And you might say, no, I think the futures is truly and honestly worth 4,500. And we can have legitimate arguments about it. Is it just a matter of opinion, or is there something more solid to it? Okay? There is something very serious and very solid to it. So let me say it. All derivatives pricing is based on arbitrage and arbitrage alone. So as I say in the slide, when we say that FV is the fair value of an option, okay? FV is the label that we use for fair value. Okay? So when I say FV is the fair value of an option, what I mean is something very strong. What I mean is that if on the market the option is going for something other than FV, then I can make money out of that by doing arbitrage. It's a very strong statement. When out of the entire analysis we arrive at a conclusion saying that this option has a fair value of 10 rupees, then that 10 rupees actually has a special sanctity. That if the price was either 9 rupees or 11 rupees, it would be possible to initiate an arbitrage strategy and make money for free without taking any risk. Therefore, 10 rupees is the only place where the market stops. You know, where the market stops moving. At 11 rupees, people will be doing arbitrage. At 9 rupees, people will be doing arbitrage. The fair value is the only place at which the derivatives price is not moving because of arbitrage. Okay, so there is a very special meaning to saying fair value in the context of derivatives. Okay, now you need to believe that there are a lot of greedy people in the country. I think that's an absolutely true statement. And you need to believe that people don't like to take risks. I think that's also a very reasonable statement. Okay, sometimes people like to go to casinos and gamble a little, but fundamentally, when you deal with your own money, when you deal with your investment strategies, you don't like to take risks. So, I don't think there's anything unreasonable about saying that there are lots and lots of greedy people in the country, all of whom would like to make money for free without taking any risk. Okay, so that's why I say that whenever the market price of a derivative is different from the fair value, I would expect a lot of greedy people to immediately jump in and try to make money without taking any risk. Okay, and that arbitrage will tend to push the price back to the fair value. So that's what's special about the fair value of an option. It's not just my opinion of what the option is worth. It's something very, very powerful compared to that. It's the only option price where you cannot make money by doing arbitrage. It's the only place where the option price stops moving. Okay, we call this the no arbitrage condition. So in all financial economics, you will always encounter this no arbitrage condition, that a market satisfies a no arbitrage condition when there are no arbitrage opportunities. And at that point, the market price stops moving in a derivatives market. In derivatives pricing, I have no idea about why the spot price is whatever it is. Okay, so you ask me what is the gold spot price today, I have no idea. Is it 4,000, 5,000, 7,000, 9,000, 2,000? I have no idea. I have no deep story, I have no great intuition, I have no great insight to offer about why the gold price is whatever it is. Similarly, I have no great insight to tell you about the Nifty spot. Okay, Nifty spot is 1150. Why is it 1150? I have no idea. Okay, I don't have a deep story to tell you about the spot price. However, once we know the spot price, once we agree on what is the spot price, I can tell you plenty about the derived price, about the derivative. Okay, I can tell you a very clear story about what the future should be worth, what the options should be worth, and what is more, that story has teeth. Those teeth are arbitrage. Okay, that the derivatives price is linked to the spot price by arbitrage, and if the derivatives price tries to move around, it tries to do something funny, then immediately arbitrageurs will jump in and they will pull the two prices into the correct relationship. Okay, so that is the entire game of all derivatives pricing. Whether you study options or futures or swaps or any derivatives, in all derivatives pricing, the game is that we take the spot price for given, we come up with an arbitrage story about how the derivative should move, and that's it. That's how we know how the price comes out. Okay, so that's the game plan. But we need to understand an arbitrage relationship between the spot price and the futures price. When we do that, we are done, because we have found out a story about how the futures should be priced. Okay, so now I'm going to take as an example a gold futures market. I'm taking gold because gold is simple. All of us have a familiarity with gold, but the story actually works for everything. If you understand gold futures, you will understand index futures, you will understand all kinds of futures. So let's just concentrate on gold. I'm going to work through some numerical examples. So work with me through every little detail in the calculation, and then you'll be in business, because once you understand how these calculations are made, you will not have any problems in terms of comprehending futures pricing. Okay, it all sounds very glamorous, it sounds very exciting, it is very glamorous, it is very exciting, but it's actually very simple. So you just play with me for the next 20 minutes and you will know what futures pricing is about. So here are the rules of the game. I'm going to say that today is the 31st of May. Okay, I'm going to pretend that the gold spot price is 4,000 rupees per tola. Okay, it's just an assumption. And I'm going to say that the interest rate is 1 rupee per month. Okay, it's a borrowing lending interest rate, it's 1 rupee per month. Now comes the question. I come to you and I say, I want to buy gold from you for delivery on 30th of June, which is 1 month away. Okay, that's a futures contract. Okay, I would enter into the contract today, I would go to NSE and I would buy a futures contract which expires on 30th of June, and if I stay long through the entire period, then on the 30th of June I would need to bring money to NSE, you would need to bring gold to NSE, and the transaction will be completed. But now we have to agree on the price. What is the price? What is the fair price of 30th June gold? It's different from spot gold. If I come to you for spot gold, you know the answer, it's 4,000 rupees per tola. That's the market price. Now I'm asking you a different question. I ask you, without your taking any risk whatsoever, what would you charge me to make a promise to sell me gold on 30th of June, which is 1 month from today? Okay, the answer is apply 1 month interest cost on the spot price of gold. Okay, also you need to worry about any storage cost. I'm going to pretend we're doing 1 tola. So 1 tola you just keep in your house. You won't go to a bank, safe deposit vault, there won't be any depository charges, and so on. So if 4,000 is the spot price of gold, then at a 1% interest rate, the futures price of gold is 4,040. That's it. Okay, it's a very simple argument, saying that the futures price is equal to the spot price plus the cost of carry. Again, I'm emphasizing this is to be completely riskless. What is your strategy? You will go to the market, you will buy gold for 4,000 rupees, you will keep the gold in your house, then 1 month later when I come to you, I'll pay you 4,040 rupees, you'll give me the gold. You're not taking any risk. Okay? You borrowed 4,000 rupees for a month, for which you're paying 1%. You are not vulnerable to any movements in the gold spot price. So whether gold price goes up or gold price comes down, you don't care. Why? Because you have the gold in your pocket, right? 1 month from now, you give me gold which is in your pocket. So you don't take any risk in terms of gold price movement. So whether gold price goes up or the gold price goes down, you are covered because you will give me the gold and I will give 4,040. So once the deal is struck, you don't have any risk, I don't have any risk. So without taking any risk, 4,040 seems to be a fair price. Okay. Now, here comes the excitement. So I'm making the claim that the fair price for 30th June gold is 4,040. Note the language I'm starting to adopt. When we say gold price, we no longer say gold price. We always attach a date to it. I will never say gold price. I will say spot gold price or futures gold price. I will not say futures gold price. I say 30th June gold price. Okay. Whenever you want to discuss price, you always attach a date on it. So when I say spot gold, I mean for right now. I'll give you the money right now. You'll give me the gold right now. When I say 30th June gold, I mean on 30th June, I'll give you the money. You'll give me the gold. Okay. So I'm claiming that the fair value of gold for delivery on 30th of June is 4,040. Now comes the challenge. Suppose you say that's not the case. Suppose not. Okay. Suppose that there is a futures market. We go to NSE. They are trading 30th June gold. Okay. There is a futures contract on NSE that is trading. And suppose we see that the price on the futures market is 4,060. It's not 4,040. Okay. What do? That's something wrong. My theory is going wrong. It was supposed to be 4,040, and on NSE you saw the price was 4,060. Now here's what you can do. It is possible to construct an arbitrage strategy without taking any risk whatsoever. You will walk away with 20 rupees in your pocket. Okay. Is that exciting? If you see the situation, the fair value calculation shows you something is worth 4,040. You go to NSE, you see it's worth 4,060. So you can buy and sell for 4,060. In that situation, I can show you a way to do some trades, to take no risk at all, and to make 20 rupees and walk away with 20 rupees in your pocket. Okay. Is that exciting? Let's do it. Okay. That's good. Now here are the steps. Look at the slide, concentrate entirely on the slide. Okay. This is really the gory details of how we do arbitrage. So play with me blow by blow. Okay. Every single step, let's be sure that you understand it completely. In arbitrage, we undertake certain transactions today, and then we will make some money on the future date. So let's see what I do today. Okay, gold on NSE on the futures market was going for 4,060, which was too much. Okay, it was a very high price. Let's apply our basic intuition. When something is too cheap, I like to buy it. When something is too costly, I like to sell it. Right? So I go to the futures market and I sell gold. Here, I'm promising to deliver gold on the 30th of June for 4,060 rupees. Right? That is the meaning of selling on a futures market. But today, no money goes out of my hand. Right? So the cash outgo is 0 rupees. Okay, see here, the 0 rupees. But I'm committing that on the 30th of June, on NSE, I will deliver gold, for which I will be paid 4,060 rupees. But today, there is no cash outgo. That's why I count that as 0. Okay. Now, I need to hedge myself, because I promised that at a future date, I'll be delivering the gold. So what I do is, I buy gold from the spot market for 4,000 rupees today. So that is step number 2. That is, I'm buying gold from the spot market, but for this, 4,000 rupees has to go out of my pocket. Because money goes out of my pocket, I put a minus sign on it. Okay. So that's why I say, buy spot gold for 4,000 rupees, I put a minus 4,000 on it. Now when we do these arbitrage calculations, you must always be very careful that the first leg of the transaction, you should always make the calculations so that the net money outgo from your pocket is 0. Okay. It's just a convenient thumb rule which you should use in all these calculations. So I say that you should finance this 4,000 rupees of expenditure to buy spot gold. You should finance it by borrowing. Okay. So I want you to borrow 4,000 rupees, use those 4,000 rupees to buy gold. So that's minus 4,000 plus 4,000, that cancels out. Simultaneously, sell gold on the futures market, promising that on 30th of June, you will deliver gold and you will get paid 4,060 for that. Okay. You should do these 3 actions today. Okay. That's the first leg of the arbitrage. Now we go to the future. On the 30th of June, what will you do? On the 30th of June, you go to NSE and you will deliver this gold. And NSE will pay you 4,060 rupees. Why? Because that was a promise. Remember, the futures price was at 4,060. So you had entered into a contract saying on the 30th of June, you will deliver 1 tola of gold and they will pay you 4,060 rupees. They are supposed to and they will pay you. Okay? Then immediately you will repay the loan. You have taken a loan of 4,000 rupees. But now when you repay it with 1% interest, you will actually repay 4,040 rupees. On net, you are left holding a profit of 20 rupees. Okay. See the sequence of transactions? I enter into what is called the first leg of the arbitrage today. What do I do today? I sell off the futures because they are overpriced. Okay, basic sanity in all financial market trading. If something is cheap, I like to buy it. If something is costly, I like to sell it. So the futures were too costly. They were worth 4,040. On the market, they were going for 4,060. So I sell the futures for 4,060. Back to back, I hedge myself. How do I hedge myself? I buy gold on the spot market. How do I finance that? I take a loan. Okay, that's the first leg of the arbitrage. At the future date, I go to the futures market, I deliver the gold, they pay me 4,060. Why? Because that's what was promised. That's the whole meaning of being in a futures market. Out of that, I repay my loan, that was 4,040. I'm left holding 20 rupees in my hand without taking any risk whatsoever. That's what's exciting. You have not taken any risk whatsoever. In this intervening period from today till 30th of June, whether the gold price goes up, gold price goes down, you don't care. You're not being a speculator. You're not taking a view on whether gold is too cheap or gold is too costly. Okay, this is riskless. That's why this is called arbitrage. Now, this is called cash and carry arbitrage. Why is it called cash and carry arbitrage? Because I'm putting down cash right now, I'm buying the goods, and I'm carrying the goods till the futures expiration date. It's called cash and carry. That I put down cash right now, I buy goods, and I carry the goods with me till the futures expiration date. On the futures expiration date, I deliver the goods. Okay, why? Because I had promised that I was going to bring the goods to the futures market, and the futures exchange will give me money for the goods. Okay, this is called cash and carry arbitrage. So we have answered one question, that when I claim that the fair value of the gold futures is 4,040, if by mistake, for any reason, out of stupidity, whatever, on the gold futures market, if the gold futures price is 4,060, that error, that 20 rupees error, I have shown you a concrete and completely articulated strategy by which you can enter into a set of trades where without taking any risk whatsoever, you make 20 rupees and walk away. Is that nice? Okay. Now let's just play it through. Suppose this happens. Suppose there is a gold futures market where the gold futures is going for 4,060. Okay. Remember, we have a lot of greedy people who don't like to take risks, right? All these people should jump in. They should immediately start doing this arbitrage. What is the first step that they go through? They sell the 30th June gold on the futures market. Right? All the arbitrageurs will jump into this and they will try to sell the gold. When a lot of people go and sell the futures, the price will tend to go down from 4,060 towards 4,040. So the arbitrageurs will exert a pressure on the futures price, trying to push down the futures price closer to the fair value. That is good. That's the way that the futures price comes closer to the fair value. So now you see the power of what I'm calling the futures fair value. It's not just my opinion of what the futures are worth. It's something much stronger. It is the price at which the market will stop moving. If the market goes above 4,040, if it goes to 4,050, 4,060, 4,070, immediately arbitrageurs will jump in. They will start selling the 30th June gold. And because of that, the 30th June gold price will tend to come down. And that only stops at 4,040. That's why 4,040 is a sensible price of the futures. Okay, this was cash and carry arbitrage. Okay, so note the points. Regardless of what happens to gold prices between 31st May and 30th June, whether gold prices go up or down, you're going to make the same 20 rupees. What is 20 rupees? The extent of the mispricing. Okay, so you make the fair value calculation, you see it's 4,040. You look at the NSE screen, you see it's 4,060. The difference, 20 rupees. That 20 rupees is what you will make, regardless of what happens to the gold price after that. Now, I did all this calculation for 1 tola of gold. But actually, you're welcome to do this for 1,000 tola. Okay, you do larger arbitrage transactions, it's perfectly feasible. How much ever capital you can put into it, that much you can do these transactions. Internationally, people are cycling millions and millions, hundreds of millions of dollars through arbitrage transactions. They are not small transactions. I just showed it to you as 1 tola for illustration. Okay, and I call this cash and carry because you put up cash now and take the goods into the futures expiration date. Okay, let me reiterate. When does cash and carry arbitrage work? Cash and carry arbitrage works when the futures are overpriced. Okay, when the futures are overpriced, the fair value is 4,040. If the futures price goes above 4,040, you would like to dump the futures. You would like to sell the futures. Remember, our basic instinct in finance is if something is cheap, I like to buy it. If something is costly, I like to sell it. Cash and carry arbitrage involves selling the futures. Why would you sell futures? Because they're too costly. So if the fair value is 4,040 and the market's price, the secondary market futures price is more than 4,040, then you can initiate a cash and carry arbitrage. Okay, now I turn this upside down. So I've showed you that if the fair value is 4,040, if the futures price is anything above that, I've shown you how to make money on that. Now let's play the reverse side. Suppose the fair value is 4,040. Suppose on the market the futures are too cheap. Okay, I get asked this question all the time somehow in the context of index futures. Nifty is at 1150 right now. What if the futures price of Nifty is 500 rupees? Okay, somehow people worry a lot that the futures price can become very, very low. Okay, what will happen in that? Okay, so now I'm going to turn the situation upside down. Let me again play with things numerically. Let's walk through every step. The situation is the same. Okay, today is the 31st of May. The rate is 1% per month. Gold spot is 4,000 per tola. Okay, we calculated the fair value of gold for 30th June delivery is 4,040. On the futures market for gold, somehow by mistake, the gold futures price is 4,020. Okay, the fair value was supposed to be 4,040. Instead, the futures price is below. There's a 20 rupees gap. Now, we want to find a way to make 20 rupees without taking any risk. What are the steps that I go through? Okay, this is called reverse cash and carry arbitrage. Okay, it's the opposite of cash and carry arbitrage. It's called reverse cash and carry arbitrage. So remember, when the futures were too costly, we did cash and carry arbitrage. Now that the futures are too cheap, we do this thing which is called reverse cash and carry arbitrage. Now, it can be written down in different ways. I'm going to write it in a certain way. I'm going to say, imagine that you already had some gold. Okay, you will see that actually even if you don't have gold, you can do similar gains. But right now, I'm going to pretend that you have 1 tola of gold in your pocket before this arbitrage transaction starts. Okay, now let's watch the transaction. Again, I've written this down step by step, so play with every single step. If you understand it, you've got it. Okay, let's go through it. So I said that pretend that you have 1 tola of gold in your pocket. Okay, step number 1. The futures price was too cheap. It was 4,020 and it should have been 4,040. So what do? I buy something that's too cheap. The futures price was 4,020. I buy the 30 gold. And for this, I have to pay nothing on the futures market. That's why I put a sign of 0 on it. Okay, so here there's a sign of 0 because when I enter into a buy position on the futures market, I don't have to pay anything. Okay, but now I have a long position on the futures market. How do I hedge myself? For hedging, I sell off my spot gold. Okay, so I had 1 tola of gold, I sell that off. I take 4,000 rupees from the spot market. That 4,000 rupees I dump into a Government of India treasury bill. Okay, so that minus 4,000 is money that goes out of my hands. So I spend that 4,000 rupees on buying a treasury bill. Okay, so I have gold in my pocket, I sell off that gold. The proceeds which I obtain 4,000 rupees out of this. I invest in a treasury. And in all this, I have a long position on the futures market. Okay, that is it. That's how I have initiated the position. Now I go to sleep till the 30th of June. On the 30th of June, the entire story unwinds. This is called unwinding of the arbitrage. Okay. First, I sell off my treasuries. Remember, the 1 month interest rate was around 1%. So the bills that I purchased for 4,000, I'll be able to sell them off for 4,040. So I realize 4,040 in my hand. Okay. Then I go to NSE. At NSE, I had a futures contract. Said that I was supposed to pay 4,020 and I was supposed to get a total gold. Why? Remember, there was a futures price. There was a futures price which was 4,020, which means that when I entered into the contract, I was supposed to go to the futures market and pay up 4,020 and they were going to give me a tola of gold. Okay, so I do that. I pay 4,020 and I get back my tola of gold. What am I left with? 20 rupees of profit. Okay, remember, I started this whole story with 1 tola of gold in my pocket. I ended this whole story with 1 tola of gold in my pocket, and I ended the story with 20 rupees. Okay, cool, clean cash. So this is called reverse cash and carry arbitrage. So you see, it's not just my opinion that this is the fair value of the futures. There's actually a powerful story behind it. That story is based on a lot of greedy, smart people all over the country who don't like to take risks. Okay, do you believe there are a lot of greedy people in the country? Yes. Do you believe that these people will be happy to make 20 rupees without taking any risk? Yes. All these people will be looking at the futures price, constantly asking, the fair value 4,040, is it going up, is it going down? If it goes up, I will hit with the cash and carry. If it's going down, I'll hit with the reverse cash and carry. I intend to keep the futures price at the fair value. Okay, that's how futures markets work.